Welcome to our comprehensive guide on understanding your tax return. In this tutorial, we'll delve into the details of taxes, covering key concepts, calculations, and common questions. By the end, you'll have a better grasp of how to manage your taxes effectively. Let's start with the basics. What is a tax return? A tax return is a form or forms filed with a taxing authority that reports income, expenses, and other pertinent tax information. Tax returns allow taxpayers to calculate their tax liability, schedule tax payments, or request refunds for the overpayment of taxes. There are various types of tax returns. For individuals, Form 1040 is the standard form, while businesses generally use Form 1120 for corporations. Let's break down the key sections of a Form 1040. Your filing status determines the tax rate and standard deduction you are eligible for. The main filing statuses include single, married filing jointly, married filing separately, head of household, and qualifying widow. Each status has its own advantages and considerations. Let's look at an example. Suppose you are married and filing jointly. This provides the highest standard deduction. For the year 2022, the standard deduction for married filing jointly is $25,900. Next, we have to understand how taxable income is determined. Taxable income is your total income minus any deductions and exemptions. Let's break it down with a simple formula. Imagine you earn $70,000 in a year. If you are married filing jointly and claiming a standard deduction of $25,900, your taxable income would be. Now let's discuss tax rates. The U.S. tax system is progressive, meaning that higher income is taxed at higher rates. For instance, in 2022, if you're married filing jointly, the tax brackets for the first $20,550 of taxable income is 10%, the next $63,000 is taxed at 12%, etc. Let's calculate the tax for our example with $44,100 of taxable income. The first $20,550 is taxed at 10%, which equals $2,055. The remaining income, $44,100 to $20,550 equals $23,550, is taxed at 12%, which equals $2,826. Therefore, the total tax liability is. Deductions can significantly reduce your taxable income. Common deductions include mortgage interest, state and local taxes, and charitable contributions. For instance, if you paid $5,000 in mortgage interest, you can subtract that amount from your total income. Let's take a closer look at some common deductions and their limits. For example, state and local tax deductions are capped at $10,000. This means if you paid $12,000 in state and local taxes, you can only deduct $10,000. Credits are another way to reduce your tax bill, but they work differently than deductions. While deductions reduce your taxable income, credits reduce your tax liability dollar for dollar. Some common credits include the child tax credit and the earned income tax credit. Let's compare deductions and credits. Imagine you have $44,100 in taxable income, and you're eligible for a $2,000 tax credit. This credit reduces your tax bill by $2,000 directly. If instead you had a $2,000 deduction, it would only reduce your taxable income to $42,100, which would lower your tax liability by a smaller amount, depending on your tax bracket. Next, we need to discuss tax withholding. Employers withhold taxes from your paycheck and send it to the government. The amount withheld depends on your W-4 form, which you fill out when you start a new job. It's important to check your withholding to ensure you're not overpaying or underpaying taxes throughout the year. Employers use the withholding table to determine how much tax to withhold from your paycheck. Let's say your annual salary is $50,000. Your filing status is single, and you claim one withholding allowance. According to the 2022 IRS withholding table, your employer would withhold about $4,595 in federal income tax over the year. It's also essential to understand estimated taxes. If you're self-employed or have significant income from investments, You may need to pay estimated taxes quarterly. These are advanced payments for taxes you might owe at the year's end. For instance, if you are self-employed and expect to owe $10,000 in taxes for the year, you would pay $2,500 per quarter. Failing to pay estimated taxes can result in penalties. Let's review some common questions about taxes. First, what happens if you make a mistake on your tax return? If you realize you've made an error, you can file an amended return using Form 1040-X. It's crucial to correct mistakes to avoid penalties and interest. Another question is, what should you do if you can't pay your tax bill? The IRS provides payment plans for taxpayers who can't pay their taxes in full. It's better to set up a payment plan than to ignore your tax bill, as the latter can lead to more severe penalties and interest. One might ask, how long should you keep your tax records? Generally, you should keep your tax records for at least 3 years. However, if you file a claim for a credit or refund after you file the return, the period of limitations is generally extended to 7 years. Finally, let's talk about tax refunds. If you overpay your taxes, you will receive a refund. To check the status of your refund, you can use the IRS's Where's My Refund tool. Refunds can take a few weeks to process, so patience is key. We've covered a lot of ground today, from understanding the definition of a tax return to calculating your tax liability, navigating deductions and credits, and handling tax withholding. The key to managing your taxes effectively is staying informed and organized. Thank you for watching our comprehensive guide on understanding your tax return. If you found this video helpful, please like, share, and subscribe for more finance tutorials. Have any questions? Leave them in the comments below, and we'll do our best to answer them. Until next time, take care.